So the long-awaited GDP report for Q3 finally dropped, and wow, on paper it was a banger. The US economy grew at an annualized rate of 4.3%, which blew way past expectations and pretty much beat anything we've seen over the past couple of years. It's especially impressive when you remember that earlier this year in Q1, GDP actually dipped slightly negative. Now, in social media and in the news, everyone is kind of like, hip hip hooray, Trump saved the day, everything's gonna be okay. And look, parts of the report are genuinely good. But when you look under the hood, the story is a bit more mixed. So let's talk about the good-ish, the bad, and the ugly. The good-ish. Exports went up, particularly in digital services and for things like cloud computing, data storage, and advanced technology, which is mostly driven by AI chips and hardware. AI and technology is continuing to be the major driver in this economy. Another key contributor was government spending, which was surprising because I thought it was going to go down due to the DOGE efforts and other things that have been in the news. But it's not. And that's because it's led by defense spending. And while these are parts of the positives, depending on your interpretation, they suggest parts of the economy are still expanding and globally competitive. But here's the bad. Most of the GDP growth came from consumer spending, which is not shocking, but it's a type of consumer spending. And when you dig deeper, the largest contributor to GDP growth was healthcare spending. So before we pop the champagne, that's not because people decided to suddenly consume more healthcare, it's because healthcare costs keep rising. So GDP goes up even when prices go up, even if nothing else changes. So like same doctor, same appointment, higher bill. The next major contributor of GDP was growth in travel, leisure, and experience-based spending. Flights, hotel, dining, entertainment, streaming, subscriptions, all still happening. They're just getting more expensive. And you've probably seen that your subscriptions have been going up. People aren't buying more houses. They're not pouring money into renovations or big ticket investments. They're not buying more goods per se. They're just paying more for them. And finally, the ugly. Business investment weakened and actually dragged on GDP. Companies aren't building inventories. They're not broadly expanding production capacity. That's usually not what you see when businesses are feeling wildly confident about future demand. The big exception, of course, is AI infrastructure and data centers. That's where the money is going. Everywhere else, not so much. And at the same time, imports fell, which technically boosts GDP. But that doesn't automatically mean strength. Because of tariffs, we have higher prices on imported goods. And that's one of the quiet drivers of GDP, which is inflation. The CPE report came out this week, and while inflation is not exploding, it's sticky, which means that it's not really going up or down. But prices are continuing to rise, and this contributes to growing GDP. And when you look at the big picture with rising unemployment, steadily increasing credit card debt, it begs the question, is the economy really as healthy as it seems, with major components of expansion being rising costs, dependence on AI growth, and defense spending? So should we celebrate? Well, look, 4.3% is really strong growth. You can't say no. But you can't ignore that most of the growth is by consumer spending more on basic necessities and the experiences they've already been experiencing, while business investment softens and imports fall. It starts to look less like a booming economy and more like late cycle behavior wearing a nice suit. So strong headline numbers, mixed reality, slightly awkward vibes with spending. We'll see how it all plays out. Stay tuned.